Well, good morning, ladies and gentlemen. Over the next 10 to 15 minutes, I'm going to give you an update on the performance of the ProVen VCTs over the last 12 months. But before I do that, I'd just like to highlight the fact that the performance of the VCTs is driven by the companies in the portfolio. And several of these companies are exhibiting here today, so I do encourage you to visit their stands in the foyer and talk to the representatives once the formal presentations have finished. And I'd also like to show you now a short video which showcases some of the companies in the ProVen VCT portfolio. So I hope that gives you a good feel for some of the 42 companies that we have in the ProVen VCTs portfolio at the moment. So on with the presentation, and because I'm talking about performance, I have to remind you that past performance is not necessarily a good guide to what's going to happen in the future. So first of all, an overview of ProVen VCT, just over £110 million of net assets, 42 investments, and the largest investment is Infinity Reliance, trading as My First Years. My First Years had a bit of a boost when Prince George was spotted wearing one of their personalised bathrobes for one of his early public appearances. And I hope that following the recent announcement from Prince Harry and Meghan, we will soon see their baby following in the same footsteps. Moving on to ProVen Growth and Income, also approaching £110 million of net assets, 41 investments, and the largest investment in Chess Technologies. And as a contrast to some of the fluffiness of the My First Years products, I thought I'd also show you one of the Chess products. Chess is a manufacturer of surveillance systems for defence and security applications. So looking now in a bit more detail at the performance of ProVen VCT, this shows the total return of the fund over the last 5 years. And the total return is the sum of the net asset value and the total dividends paid. So this slide shows the net asset value at the 31st of August in each of the last 5 years. That's the grey bar. And then the light blue bar shows the cumulative dividends paid over that 5-year period. And you can see that the net asset value has gradually increased over the 5 years and now stands at just short of £1.09. And the total dividends paid is 33.5p. So adding those two things together means that the total return of ProVen VCT has increased by just over 44% over the 5-year period. Looking now at the dividend performance, this slide shows the annual dividend yield for each of the last 4 years in the dark blue bars, the last 4 financial years. And then the light grey chart is the yield for the current financial year based purely on the dividend which is going to be paid in November. And you can see that we've exceeded the target yield of 5% in each of the last 4 years. And with this year's, with the dividends going to be paid in November, the average dividend yield over that 10-year period is 10%. Similar slide for ProVen growth and income. Again, the grey bar is the net asset value and the blue bar is the cumulative dividends. Here, the net asset value has stayed at or above the target NAV of around 80 pence per share. It fell slightly in the last year following the 10.25 pence dividend that we paid out following the sale of Thirdbridge in July last year. The total increase in total return over the 5-year period is just over 30%. And looking again at the dividend yield, again, we've exceeded the target dividend yield of 5% per annum in each of the last 4 financial years. ProVen growth and income will also be paying a special dividend in November of 4.5 pence per share, which equates to a yield of 6.2% on the opening net asset value. Now, it's important to point out that those returns that I've just quoted don't take any account of the VCT tax reliefs, which are obviously an important part of investing in a VCT. So once the initial 30% tax relief has been taken into account, then the increase in the value over the effective net asset value per share for ProVen was 107%, i.e. it more than doubled over a 5-year period. And for ProVen growth and income was 86%. And similarly, the yield that I quoted takes no account of the initial tax relief. So if you net off that from your initial cost per share, the effective yield is around 14.3% for ProVen and 11% on average over the 5-year period. Now, one point I wanted to highlight, although Malcolm has obviously mentioned it already, is the significant disposals that have taken in the last 18 months or so. The sale of 3 companies, Thirdbridge in July 2017, and Chargemaster and Watchfinder in July this year. July is obviously a good month for selling companies. Generated total proceeds of £56.5 million. And these proceeds have been driving significant dividends, as you can see from the chart. If you add those dividends up, that equates to an average over the 2-year period of 17.1% yield for ProVen and 10.5% yield for ProVen growth and income. Now, I'm sure that most of you will have spotted that the performance of ProVen and ProVen growth and income over the last 5 years has been different, and you may be wondering why. First thing to say is that both VCTs have the same investment policy, and that means that each time we make a new investment, generally both of the VCTs will participate in that, but not necessarily on a 50-50 basis. There's a detailed co-investment policy between the VCTs, which is used to allocate investments. And this is designed to make sure that the oldest funds are invested first, to ensure that the qualifying percentage we need to hit and maintain for the VCT regulations is always in excess of the target. Now, the approach we've taken to fundraising over the last few years, with one VCT raising money one year and the other VCT raising money the next, has resulted in differences in allocation for new investments, which have sometimes been significant. We're aiming to address this in the future, and one of the first steps in that is going to be the joint fundraising that we're going to be launching later this year, which will be on a 50-50 basis for the 2 VCTs. And that should help to bring the allocation back into line so that each new investment has a more balanced allocation between the 2 VCTs. Now, one of the questions we often get asked is, how does the performance of the ProVen VCTs compare to other VCTs in the market? And we always like to give you what you ask for. So here's a slide which shows the performance of a number of VCTs over a 10-year period. And what it shows is something called the net asset value total return, which is calculated by assuming that any dividends that are paid are reinvested in the VCT at the net asset value after the payment of the dividend. And the figures come from the AIC website, publicly available. AIC was formerly the Association of Investment Companies. If you spot any inaccuracies in the figures, please complain to them, don't complain to me. So this slide shows the performance over a 10-year period. There are 31 VCTs that have a track record of 10 years or more. I can't get them all on the chart, so I've showed the top 5 performers, a couple of groups in the middle, and then the worst 5 at the right-hand side of the chart. The green bar represents the position of ProVen, which is in the second quartile, and the blue bar is ProVen growth and income, which is just below the halfway mark. Now, when you look at that chart, it's quite interesting to note that the VCTs that have got the best performance over 10 years are those that have been investing until quite recently predominantly in management buyouts. And it's important to say that the environment for those VCTs has been very favourable over the last few years. They've been able to gear their investments with significant amounts of debt at low interest rates. And in addition, those VCTs have typically been investing in larger companies and therefore less risky businesses than those VCTs like the ProVen VCTs, which have been investing in growth capital over the same period. But following the VCT rule changes in November 2015, investing in management buyouts by VCTs is no longer allowed. And so when we look at the next slide, which looks at the performance over 5 years, it appears that this may already be having an effect on the relative performance of those VCTs that previously invested mainly in buyouts. So this shows the net asset value total return of various VCTs over a 5-year period. There are 37 VCTs with a track record of 5 years or more. And again, I've shown the top 5, a group in the middle, and the worst performers. As Malcolm mentioned, ProVen VCT is now the top performing VCT over a 5-year period based on net asset value total return. And it's turned, with dividends reinvested, it's turned £1 into nearly £1.60. ProVen growth and income is again in the middle of the table. It's turned £1 into £1.32, the dividends reinvested, whereas the worst performer at the right-hand slide has managed to turn £1 into only 85p, which is quite a feat. Now, we often get asked about the level of cash in the VCT. So what I've tried to do is to show you how we manage the cash movements within the VCT. This shows the main cash movements in ProVen over a 2-year period. And I've chosen a 2-year period because until recently, the VCTs have raised alternately on a 2-year cycle. So for ProVen VC, it shows the main cash movements between the 1st of September 2016 and the 31st of August this year. And I've also shown the forecast position at the 30th of November following the payment of the interim dividend. At the 1st of September 2016, the VCT had £36 million in cash. During the 2 years, we generated £51 million from realisations and invested 23.2. So you can see that actually we got back about £28 million more in cash from realisations than we made in new investments. But the last 2 years has been a very strong period for investment realisations generally, and we can't rely on that being the case in the future. So we need to plan the cash needs of the VCT, assuming that the market for selling companies dries up, or at least isn't as attractive as it has been over the last couple of years. The VCT then paid out about 12 million in dividends. It spent nearly 14 million on operating expenses and the share buyback programme, buying back shares from investors, which left it at the 31st of August, before any fundraisings, with 38.4 million. We actually had a small fundraising during the last tax year, so the actual position at the 31st of August was £42 million in cash. But the dividend that's going to be paid in November is going to use up £25.5 million of that cash and leave the VCT with only 16 million at the 30th of November. So you can see that with that level of cash, it's not going to be able to continue to keep making investments for very long before it runs out of cash. And for that reason, we're launching the fundraising in December. This is a similar chart for ProVen Growth and Income. It started the 2-year period with £10.5 million of cash. Also had an excellent period for realisations, generating £41 million and invested £19 million. Paid out 19 in dividends, about 12.5 in operating expenses and share buybacks, which meant that had the VCT not undertaken a fundraising during the period, it would have been down to only £1 million of cash by the 31st of August this year. But in fact, we did have a big fundraising, not in the last tax year, but the one before, and we raised £41.1 million for ProVen Growth and Income, which meant that the actual cash position, the 31st of August this year, was £42.2 million. 6.5 of that is going to be used up in paying a dividend in November, which is going to leave us with just under £36 million of cash. Now that may seem like a reasonable level of cash to have in the VCT, but because of the requirement to always maintain a certain specified level of investment in venture capital investments, we have quite ambitious investment targets for ProVen Growth and Income over the coming year, which will use up most of that cash. So for that reason, we're again going to be raising money for ProVen Growth and Income in the joint offer with ProVen VCT. Now, my final slide, I put in here as a blank, was to be an update on the announcements in the budget yesterday that affected VCTs. But fortunately, there weren't any. And I'm very pleased to say that we're not going to have to change direction again. However, the government did publish yesterday a document called Financing Growth in Innovative Firms 1 Year On, catchy title, which was a follow-up to the Patient Capital Review. And this new document mentions on several occasions how the changes made to VCTs following the Patient Capital Review are achieving the government's objective of redirecting VCT investment towards knowledge-intensive companies and companies which have got a potentially higher growth profile. And I think that acknowledgement is very good news for the VCT industry in general. So that concludes the presentation on the performance of the VCTs. In the next session, we would like to try to illustrate what's involved in making a new investment. We're sometimes asked if it's fair that we charge the same management fee on the cash in the VCT as we do on the investment portfolio. But in fact, the majority of the work and the time spent by the investment team is actually spent on putting this cash to work in venture capital investments. So to talk us through what's involved in finding investment opportunities, sorting the good from the bad, and closing the deal, I'd like to invite to the stage two of the senior members of the investment team at Beringier, Maria Wagner and Eyal Malinga.